Hello, and welcome back to the channel. Don't you just hate it? You've worked your butt off all year round, you've saved up a ton of money, and then February hits. The CRA, or the IRS if you're American, is banging down your door, demanding the rest of your hard-earned cash. Here are some tips to keep as much of that hard-earned cash as you can. But first, if you find this video helpful, hit the like button down below and hit the subscribe button. It helps me grow. Keep in mind, I am not a licensed accountant or a tax advisor. Please consult a tax advisor or an accountant for your specific situation. Income is generally taxed on a progressive or graduated scale. In the example shown up here, first $10,000 of income is taxed at 5%, $10,000 to $40,000 of income is taxed at 10%, $40,000 to $80,000 of income is taxed at 25%, and $80,000 to $150,000 is taxed at 37%. Assuming an individual made the full $150,000, this is a total tax deduction of $39,400. This is why it's important to reduce your taxable income as much as possible, as it can result in a fairly substantial return if you can bring your income down to a lower tax bracket. With the aforementioned tax rates, if you have an income of $100,000 and you can reduce that to $80,000, your tax return would be in the $7,400 range. First, get all your tax slips together. Keep records throughout the year of all your retirement account contributions, real estate and personal property statements if you're renting out space, home office expenses, any charitable donations, any business expenses if you're running your own business, etc. You or your accountant will need this when it comes to file your taxes. You should keep these records for at least 7 years, as you can be audited in the future. Personally, I just scan everything, save it into folders into the computer by date. This way I can keep it all together, and since I file my taxes online, it makes it really easy for me to see all my tax information in one place. Contributions made to a retirement account can be used as a tax deduction when it comes time to file your taxes. Some examples of retirement accounts are the 401k or the IRA, or if you're in Canada, the RPP and the RRSP. Contributions made to these accounts can be deducted on your tax return to reduce your overall taxable income and result in money back in your pocket. This is because money held in these accounts is before tax income. The assumption is that you will make less money in retirement, i.e. you are deferring the tax until you withdraw the money in retirement. Another advantage to a retirement account is that you can defer the tax to a later year. If you're in a low tax bracket, or you think you're going to make much higher income in the future year, you can save that deduction for that future year. Cautionary note, there is a limit to how much you can contribute to your retirement accounts. In Canada, this limit is 18% of your before tax income. Some employers offer a 401k or RPP match program. So if you contribute $5,000, for example, your employer will then also match that $5,000 for a total of $10,000 as a tax deduction. Finally, you do not lose contribution room. If you are not able to max out your retirement account, you can save that contribution for a future year when you're making more money. Let's look at an example. At age 40, George makes $100,000 in income. Using the graduated tax brackets from the beginning of the video, George paid a total of $20,900 in taxes. George was able to max out his retirement accounts that year, which brought his taxable income down to $80,000. This resulted in him paying only $13,500 in taxes versus the $20,900 that he paid before. Now let's look at George many years in the future. George is now 70. He is withdrawing $20,000 per year from his retirement accounts, and he has no other income. George now only pays $1,500 in taxes versus the $7,400 that he would have paid on that $20,000 back when he was 40. Another way to reduce your taxable income is with tax loss harvesting. If you have any non-tax sheltered accounts, then any capital losses that you took throughout the year can be used to offset any capital gains. Tax loss harvesting is a fairly simple concept. This is where you sell any positions that are down to offset any capital gains that you had throughout the calendar year. Keep note of the superficial loss rule. Any stocks that you sell, you cannot buy back for at least 30 days. 30 days is a pretty small window, so this shouldn't have much impact on your overall returns. Also keep in mind that time in the market generally beats trying to time the market. But if you have a stock that just keeps falling and falling and falling, sometimes it can be beneficial to sell that to offset any capital gains that you had throughout the year. This is why it's important to keep records throughout the year. Another deduction that is beneficial is any expenses associated with rental properties and real estate. Things like mortgage interest, property tax, utilities, house insurance, repairs and maintenance, and management fees are all possible deductions that you can use to offset any income associated with real estate or investment properties. You can find a complete list online. For a personal residence, you can deduct a percentage of these expenses based on the area rented out, for say a basement apartment or a garage storage space. You take the total rented space and divide it by the overall square footage, and that is your percentage that you can deduct. Usually there's a limit in your area, so consult a tax expert to find out what that limit is. Let's look at an example. In this example, it is a 2-unit investment property. Each unit rents for $1,500 and has the expenses shown here. By deducting these expenses, you bring your overall taxable income to $1,000. And then, assuming you are in a high tax bracket and paying 37% tax, your total tax on this amount is only $370. If you didn't have these expenses to deduct, your tax would be based off of $3,000 and you would pay over $1,000 in tax. If you run a business out of a home office or work from home, you may be able to deduct any expenses incurred as a result. Some examples of these are stationary costs, business dinners with potential clients, gas and car maintenance, cell phone bills, internet and liability insurance, and any health insurance premiums that you may need to pay. It is important to keep all receipts and utility bills from running a business out of your own home or working from home, as the IRS or the CRA, if you're Canadian, may want to see these to substantiate your claim. The more you can deduct off your income, the larger your return will be. You've slogged through the 40 forms, the IRS or the CRA has reluctantly agreed that you get a tax return. What do you do now? You could go buy that new driver you've been eyeing at Golf Town, or that fancy dress, or take it down to Vegas and bet it all on black on the roulette wheel. While fun, these options are not likely the most beneficial to you. I would suggest that you take your tax return and use it as the first payment into next year's retirement account, or put it in another tax-advantaged account. Thank you for watching. I hope this helped you max out your tax return. Hit that like button and subscribe below. Remember, the CRA or the IRS doesn't have to win every time.